Welcome everyone. If you're new to this channel, hit the like button. If we get 1,000 likes, I will get on the phone with my good old friend Donald Trump and tell him to pump the market. So buy the dip, please and thank you. And for those of you that are skeptical on me being on a first name basis with Donald Trump, don't be. You can trust me, bro. And if you think I'm trying to be funny, I'm not. But let's get to business. We're going to talk about stocks and the financial markets, and I'm going to help you make some money in this volatile period. So let's just cut to the intro and roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks swung between positive and negative territory on Tuesday as investors fielded a rush of fresh earnings reports and waited for the Trump administration to ease up on tariffs for automakers. Actually, very green day at the end of it all. Very solid, great breadth across the board. Earnings coming in a lot better than expected, and we're starting to see the fruits of the market's labor. Now, instead of talking about what's green, because pretty much everything was green, let's talk about what wasn't. And firstly, energy was the worst performing sector right here. Not doing too well, especially with how crude and Brent have been acting. Crude is down about 14% for the year, and these stocks are going to take a hit by and large. Google fell. It was down 0.22% on the back of what I still think was exceptional earnings. Amazon was down today as well, and that's because Amazon came under fresh scrutiny from the White House after reports that it would show tariff price increases in product price tags. The White House called the move hostile and a political act, and the shares did fall at one point down 2%, but they did recover. And to be honest, what Amazon is doing, I think pretty much every retailer that has an import charge or an export charge is going to do that as well. I don't think it's hostile. I think it's just business, in my opinion. And then we actually saw semiconductors not perform too well. Semiconductor equipment manufacturers were pretty red today, along with the broad semiconductor complex, except for Nvidia, which was up ever so slightly. Other than that, it was green across the board in pretty much every single sector. Again, except energy, that was the only red sector. And then gold was down 0.96%, taking a breath after the stellar rally it had in the last year or so. But every other sector was green. Just another broadly green day led by financials, materials, real estate, staples, utilities, XLY, discretionary, with the S&P 500 gaining 0.61%. You could see right here that the best performing was actually large cap growth, but ultimately it was really just the growth part of the market in mid caps and small caps that performed the best. We also saw core in mid caps and large caps perform, but ultimately we saw green in every single factor and size segment. Yes, there were laggards relatively speaking, but if you were just indexed to the market, you did very well today. And the reason why was continued de-escalation in the trade policy. Trump came out today and he said he was going to soften the blow on automotive tariffs after negotiation. Companies paying Trump's car tariffs won't also be charged for other levies. So if there's an initial car tariff and a tariff on steel, we sort of get to meld that into one singular tariff instead of having double duties. And he plans on doing this with a credit of up to 15% of the value of a vehicle assembled domestically, and this could be applied against the value of imported parts. So long story short, Trump is going to give automakers a 15% subsidy per car, which can be used against the cost of imported goods. I don't know why it's come to this place, but it has, and now we're subsidizing the cost of tariff cars when all of this could have been avoided. But I digress. This is the news and we're just here to report it. Now, what also kind of helped the market today was some of the earnings data. Now, when you look at the headline data, it does look a little bit scary, but when you dive into the weeds, there was actually a lot to love. Now, for example, consumer confidence came in at 86, missed consensus expectations of like 87 and 89, depending on which forecast or estimates you're looking at. So the market genuinely didn't like this overall. And then you also look at the JOLTS number, right? You could see a JOLT came in at 7.192 or 7.2 million. The expectation was for 7.48 million. Now you look at this number and say, well, JOLTS quits is going down, but it doesn't actually matter that much. The jobs openings per person is less than 1, and we're still at about the 1.4 range at the moment. And then you actually look at quits right here. Quits came in at 3.3 million versus the 3.2 million expectation. In other words, this is a positive. More workers are feeling confident that if they do quit their job, they can actually go find one. That is why the quits rate was higher. These are voluntary quits. So when you look at the JOLTS headline number, the JOLTS opening, not that good. You dive into the weeds, you see some fairly good things with regards to the consumer and the labor market. Again, we'll have to see how this pans out in the month of April and May as time goes on, because this is just the data for March. Looking at the Redbook index, up 6.1%. The consumer is still hanging in there. This is a weekly aggregate of retail sales. Very, very accurate. And then you look at retail inventories ex autos came in at 0.4 versus the forecast of negative 0.2. So the consumer is still hanging in there. The goods trade balance also beat expectations. And the housing price index did see growth on a month-over-month basis, as you can see right here, but it was a lot slower than expected. So the whole talk of potentially seeing an inflationary environment, we're not seeing that in housing prices just yet. However, and I thought the economic data today was by and large fairly positive, and that did also help overall sentiment. What detracted from sentiment today was we actually got HSBC lower their S&P 500 price target to 5,600, and this is where we stand right now. A lot of estimates have been lowered. Wells Fargo, Morgan Stanley, and UBS are the only banks or investment firms that have not lowered their S&P 500 year-end price targets, but the majority of them still see anywhere from 7 to 8% upside from the current price to their initial target. This is well up the highs at the start of the year, where we even saw targets, upward of 7,000. Now, looking at some market movers here today, PayPal was up 2%, outperforming the market. That's because it dropped its Q1 earnings. It missed on revenue, beat on EPS, maintained its guidance. This report was actually really fantastic. Active accounts grew 2%. It bought back $1.5 billion worth of shares. Margins expanded. In fact, this right here, this is the non-GAAP estimate. PayPal's GAAP estimate actually came in at $1.29. It was 56% year-over-year growth. It was absolutely insane. I think the stock is going to go a lot higher. And if you guys want to see my full review of PayPal, go ahead, follow me on FinFluential Media. About an hour or two after this video drops, I'm going to do a full PayPal deep dive, as well as a deep dive on a bunch of other stocks like Visa today. So go ahead and follow me on FinFluential Media. I'll leave a link in the comment. Visa was up 1.19% today, up 1.19% in the after hours as well, after it beat revenue estimates and earnings estimates, and its guide came in line as well. The market loves to see that, and that is why the stock was popping here, outperforming the broader market. Spotify Technologies was down 2%, but really rallied off the lows right here. In fact, apart from the weak guide and the EPS miss, which was due to timing impacts, I thought this report was absolutely stellar, particularly as it pertains to customers, customer acquisition, and customer retention rates. Great earnings, and I think if we do get again, to this low 500 area, you want to buy the dip here in Spotify. Everything looks really, really good. This number right here is purely just timing impacts. And I think when you look at the report in all, Spotify is in full throttle as per usual. Starbucks, very, very ugly earnings here. Missed revenue estimates, missed EPS estimates. Same-store sales growth fell 1% on a year-over-year base for the quarter. The expectation was for 0.6% growth. The stock was only down 1% in the after hours. So that's telling you how much is already priced into this name. And if you actually see this turn green, let's say sometime this week, that is probably an opportunity to buy, meaning that the 1% same store sales decline is already priced in. Very interesting, but a dumpster fire of an earnings. But again, it all comes back to what's priced into the stock. And then Hims & Her Health was up 20% on news that Novo Nordisk would be partnering with Hims to sell their GLP-1 drugs via direct to consumer. Novo Nordisk was also up 4% on the back of this news. Very positive developments, and it means the GLP-1 story for Hims is right on track. And then for everything we saw today, we had 3,600 advances, 2,500 decliners. We saw net inflows in the Nasdaq and the New York Stock Exchange, with the S&P 500 gaining about a 0.5 percentage point, and market momentum continues to improve. We saw improvements here in the 5-day and 20-day moving averages, and we're moving in the right direction on the medium and longer term moving averages. This is the type of stuff you want to see, but we still have a long way to go before we capture the 200, 150-day moving averages. Now, looking at the chart, a fairly positive day after everything we saw today. The S&P 500, the Nasdaq, the RSP, all of these stocks were up about 0.5%. Variances in each. We're looking a bit mixed here in the after hours. Down in the mega caps, the IWM slightly up. The RSP has no trades in the after hours just yet, but things looking largely robust, and the S&P 500 continues to chug higher, but we can definitely see that these gains are slowing down from what we saw last week, and that's just the market in wait and see mode, as we still have the big non-farms print at the end of this week, as well as some of the major earnings reports tomorrow. We get Meta, we get Microsoft, and that can definitely move the market. Now, yields continue to fall. This is good thing. The 10-year yield was just 2 weeks ago at the 4.45% range. We're now at the 4.1% range, and we may actually see the 10-year yield under the 4% mark. Did have a little bit of a growth scare there, or a yield scare, I should say, but we continue to see yields tick down, volatility tick down, still in backwardation, but inconsequential, really. As a result, bonds did tick up. Risk assets like Bitcoin were flat. Gold fell, silver fell, crude oil fell. That is why energy stocks were a bit of a dumpster fire today. Crude oil down 14% year to date. One of the worst performing asset classes in the total broader market. Now, let's actually talk about the S&P 500. Now, we said at the start of this week, ultimately what we're looking for is a move above the 5,500 area. We actually got that move, as you can see right here, and we did actually close above. Then we said what we want to see is follow through, right? And ultimately, we want to see a move and a close potentially above the 5,700 area. Now, we're slowly making our way right there, but we're unable to break above the core wall, this core resistance zone. For those of you that don't know, this is the core wall. This is the support. Above here, we're buying dips, selling rips, looking to aim for this area, right? You sort of want to trade the yellow line to the blue line with a bullish bias. When we're below the yellow line, we're in negative gamma, and you want to sell into weakness, buying to strength, looking to harness volatility to your advantage, but ultimately you're leaning with a bearish bias. Now we can see that we got to the top end of the range. The core wall didn't move up. So that is telling me something very, very interesting, that we could actually see a little bit of weakness into the end of the week as we approach some of the key data as it pertains to GDP and non-farm. So we're at a very critical level right here. So ultimately, I am expecting a little bit of weakness into the end of the week. Now, if we go higher, I am more than happy to support that. But based on my models, we probably do see a little bit of weakness into the end of the week, potentially seeing a low as 5,300. Now, if we actually take a measured move and go from there to the low, that's a 3% move. Now, it is a bit much. And if we do fall 3%, the market is going to freak out. But I'm just telling you what could happen. And we could actually see a move from where we are to the 5,300 area. But more likely than not, we probably just see a minor pullback, a digestion as the economic data and the earnings reports roll in. However, if we do get this core wall moving up, right, let's say maybe to where the current 200-day moving average is, if we get a move upward there, then I would say the next leg is probably higher. But we have not seen that just yet. Core wall has not moved up, meaning the options market is not seeing any further upside or looking to get even more so bullish from where we are. And that means we probably de-risk into the end of the week, especially with high impacts data. And that means we probably will fall and digest some of this move we made into the end of the week, into the weekend. Now you can see right here, we put in a low, we put in a higher low. And as long as we hold this 51-55 area, right, we are still on track to go ahead and take out these highs here in the S&P 500. That's exactly what we're seeing right now. We put in a low, we put in a higher low. And as long as we maintain this higher low, the trend is to the upside, because we have taken out some of the highs we made along the way. So we're seeing an initial low, a high, a higher low, and now a higher high right here relative to this high. That's very, very positive. So if we do pull back, find support and go from there, that would mean trend continuation. The one thing we don't want to do is break below the 51-55 area. Then all hell breaks loose. A very similar situation for the Nasdaq 100. We're at the top end of the range, looking for some weakness into the end of the week, but ultimately the trend is still to the upside as we put in that low and higher low. And we are actually approaching the 200-day, as you can see right here. The core wall hasn't moved up, and that's telling you everything you need to know. But it does look like there's a little bit of upside here to the end of the week. We could see a little bit of positive movement in the Nasdaq 100 if we get positive earnings reports in Meta and Microsoft tomorrow, and maybe we could see the broader market stuff like the S&P 500 pull a little bit back and just see the mega caps lead if we do get those strong earnings reports. But if those reports are weak, all bets are off for the Nasdaq 100. Now, looking at the RTY, guys, we could see here that very similar situation. We're at the top end of the range, but we continue to keep making higher highs relative to these highs right here and the lows we've put in the most recent weeks. Ultimately, what I want to see this week is a close above the 2000 area. If we can get a strong close and good volume above that, then we can go ahead and target some of these higher levels in the RTY. Let's quickly look at European stocks. The Stock 600 has officially retaken its 200-day moving average. This is ultimately where you get long. You could see a little bit of a pullback, retest this moving average, and then go from there. And you could say that you want to go ahead and target those all-time highs in the Stock 600 index. This is the S&P 500 of Europe. It's obvious that this was a great buying opportunity. It sprung off its lows in a very strong way. If we actually measure peak to trough to where we are, that's a 12% move off the lows. Very, very strong. And I think by retaking this 200 moving day average, that is a sign of confidence. And you could probably go ahead and target some of the upper levels right here, potentially all-time highs. Europe looking very, very good, all things considered. Probably looks like one of the best indices right now. So let's actually talk about gold. I mean, gold is the only index that looks better than Europe. We continue to see very, very strong buying here at this 3,300 level. It does look like the bulls are looking at this momentum and saying, I don't want to miss the next run up, especially if we continue to get volatility on the trade war front. And I think the bulls are looking at this area as value. I personally am not getting into gold right here. I just want a little bit of a deeper discount because it has been on a stellar run and it does look quite oversold. My preferred alternative asset to buy right now is Bitcoin. Now, if you're an avid viewer of this channel, you know we use M2 money supply to determine the path of Bitcoin. So this blue line right here, this is the price of Bitcoin. This yellow line right here, this is M2 money supply, and we offset it anywhere from 80 to 100 days, and that tells us what Bitcoin is going to do next. It is a leading indicator. You could see that when Bitcoin traded sideways, M2 money supply traded sideways, vice versa when it rallied, vice versa when it sold off. And now we're in this rally phase. For the last couple of weeks, I said buy Bitcoin relentlessly at these levels, and we're starting to see the next move to the upside. And guys, the ultimate target here for Bitcoin is the all-time highs. Don't get me wrong. If we are looking for a pullback, and Bitcoin can be very, very volatile, that pullback can manifest itself anywhere from 5 to 7%, potentially as much as a 10% drawdown. However, as long as we maintain these highs right here, we can pull back, right, and we can just continue the rally to the upside. So I'm personally not buying gold. If you miss the gold rush, I would probably get into Bitcoin because it does look like this move has some ways to go. And this probably is going to play itself out up until about the end of June, middle of June, somewhere around there. And I think it's a great hedge to have through all of this volatility. So for those of you that missed gold or maybe even missed equities, get into Bitcoin, especially if we do pull back, especially if we do get some weakness. And it does look like there is going to be some bouts of weakness on the way to the upside. I wouldn't even be opposed to selling some puts on a ticker symbol like IBIT. If we actually just go to IBIT, right? Let's go IBIT. You can selling like some $50 puts would be a great hedge, maybe even some $49 puts somewhere around here. That would be a great place. And if you miss the rally with those puts, if they don't get assigned, at least you collect the premium and you could just sell them on a weekly basis up until probably, you know, that middle point of June. That seems like a prudent play, especially given the volatility that we do see in Bitcoin. But for all intents and purposes, everything looks really, really good. We see yields continue to move down. It does look like this is now officially in a downtrend with a high, lower high, lower high, a lower low right here. And we are starting to see this pan out. The dollar is at the 99 level. It's sort of consolidating here, but the weaker dollar is actually a boon for some of the earnings we're seeing. For example, PayPal saw a 1% currency uplift thanks to a weaker dollar this quarter. And it does look like that's going to play out in the second quarter as well. And that's very, very positive. But for all intents and purposes, guys, do expect a little bit of weakness if the call wall doesn't move up. But if it does, do expect this rally to continue. I'll keep you guys updated as to what happens next. And diving into sentiment, this is the weekly sentiment poll. I pose a question every single week. If you want to be a part of these, go ahead and subscribe so you don't miss them. And I asked, how are you feeling about the S&P 500 this week? Are you bullish, bearish, or are you feeling neutral? 818 of you guys voted. 48% of you guys were bullish. Very, very interesting to see that. However, when you combine the bearish and neutral votes, it equals equals 52%. So the overwhelming majority of you guys, more than what were bearish, are actually more cautious and or bearish on the market this week than you are bullish. And that's very, very interesting. So while there is a bullish tilt, there is that cautious undertones. And when we look at seasonality, we should probably stress caution. We could see that the first half of May, this is the median 2-week returns for the S&P 500, tends to be very, very lackluster. In fact, we see returns up about 0.2, 0.3, and I'm willing to bet the hit rates aren't that high. So guys, do be aware that the first half of May can be very, very dicey. However, the second half, as you can see right here, tends to be very, very positive, relatively speaking. So we could be looking for seasonality that's kind of flat in the first half and up in the second half. It looks something like that, especially if we start to see trade deals come to light over the next couple of weeks. We could definitely see the back end of May really, really rally while we digest some of the moves we saw in the last couple of weeks, some of that bullish moves off the lows. And that could set us up for a year-end rally, but we'll take it 1 week at a time. And seasonality dictates to us that now in the first half of May, we should remain cautious. However, earnings is telling us to buy the dip. This is the latest blended earnings growth rates for the S&P 500, and we're looking at 10.9, nearly 11% growth. If you exclude the energy sector, we're looking at 11.7% growth here for the S&P 500. Very, very strong results for Q1, but this was the expectation, at least coming in. We were looking for about 7 to 8% growth. We are smashing those expectations, and this is part of the reason why we're seeing a little bit of strength here in the markets. Earnings lifts all boats, but this is Q1, and ultimately what we're failing to see is good guidance figures, and that is why we're not absolutely ripping on these results. Margins are also looking very good. This is the blended margins growth rate here. We're looking at 12.4%, up from 11.7% in the first quarter of 2024. Very, very solid margin profile, and that looks to increase as the year goes on. If we continue to see margins expand equaling to what we got here in 2021, and actually earnings continue to grow at this robust pace in Q2, Q3, we could be setting up for us to go and retake all-time highs. But for that to happen, the macro would need to stay favorable. Now, I want to point this out. This is the Fed's GDP now for Q1. Gold adjusted, it's sitting at just under the zero mark. The nominal figure is sitting at about negative 2.3%. I'm bringing you this because we get the GDP prints tomorrow, and I just wanted to outline where the GDP now is relative to what the number actually prints tomorrow. Now, break-even inflation rates continue to tick lower, which signals reduced pricing pressure, fostering economic stability and potentially boosting stock valuations as real returns improve. However, we are still well off the lows we saw here in July. However, 5-year, 10-year and 20-year break-evens are well off their highs, and that is a boost of confidence, all things considered. And also, when we look at federal employment tax receipts, a barometer for the labor market, things were looking really dicey at the start of April. This number was actually negative, but we really pulled through, seeing 6.1% gain in the month of April. However, the real litmus test is what is this number going to be in the month of May? And we will cover that on this channel. Looking at data ahead for the rest of the week, tomorrow is a very, very important day. I think the biggest print here is actually going to be the GDP growth rate. The consensus is for 0.4. The forecast is for 0.5. The previous number was 2.4%. I think we should probably expect a consensus, and if we get anything worse, that's not going to look good for stocks. I think if we get a good Q1 GDP growth rate, that's going to be very, very good for the markets. But if it comes in disastrous, that's not going to be great. We also get the PCE figures, the price index, and then personal income outlays month over month, and spending as well. And the consensus there is for 0.4 for both of those numbers. Core PCE to come in at 0.1. A huge week of data tomorrow. We also have a number of earnings, right? You could see here Wednesday before the open, we have Caterpillar, ADP, Garmin, Etsy, Wingstock, GE Healthcare, Humana, UBS, right? A whole bunch of very, very big earners, as well as Brookfield Corporation. Then after the close, the two big ones is Microsoft and Meta, but we also get Robinhood, right? Qualcomm, Vici, eBay, Coke, Clack, KLA Corporation, TDoc, right? Very, very strong earnings here on Wednesday after what was a pretty big day of earnings on Tuesday as well. But if you've made it up until here, Thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.